Decisions that last. Home buying step 6. Mortgage terms explained. By the time you've reached this step, you've already done more work than most buyers ever do. You've checked your credit, you've built a real budget, you've chosen a lender, you've dealt with underwriting issues, and you've put the right realtor in place. And now it's finally time to talk about mortgage types. This step matters because the loan you use determines which homes you can realistically buy. Mortgage types and property choices are tied together, and ignoring that connection is how buyers fall in love with houses their financing will never support. That's why we talk about mortgage types before we start opening doors. Some loan programs don't like fixer-uppers. Others limit where you can buy, how the home can be occupied, or what condition it has to be in at closing. Those rules can kill a deal late in the process if you don't understand them early. For example, if you're using USDA, you'll be looking in areas that meet USDA's rural definition. That usually means communities under 20,000 people, but it can also include the edges of larger metro areas. If you're using FHA, VA, or USDA, the property has to meet stricter condition standards. True fixer-uppers usually don't qualify. Thanks to home flipping shows, a lot of people think there are bargain renovations everywhere. In reality, most serious fixers never hit the open market. They're often sold directly to investors or to agents who already have a relationship with a seller. The bottom line is simple. Your loan program shapes your home search. That's why this step comes before 7, looking at houses. Most buyers hear about a handful of mortgage types: conventional loans, FHA, VA, maybe USDA guaranteed. You may also hear about jumbo loans, adjustable rate mortgages, or specialty programs offered by banks, nonprofits, and credit unions. Let's walk through the big ones. Then we'll talk about one of the most misunderstood parts of the mortgage world: mortgage insurance. For many buyers, a conventional loan is the default option. They follow guidelines set by Fannie Mae and Freddie Mac. They often allow 3 to 5% down for well-qualified first-time buyers. 20% is ideal, but is not required. They're generally more flexible on property type and condition than FHA, VA, or USDA, though they still require appraisal and basic safety standards. If your credit is solid, your debt-to-income ratio is reasonable, and the home is in good condition, a conventional loan can be a great fit. FHA loans are designed to help buyers with lower credit scores, smaller down payments, or more complicated financial histories. Most borrowers can qualify with 3.5% down. FHA is often more forgiving of past credit issues, but it comes with stricter property rules. FHA wants the home to be safe, sound, and secure. Obvious deferred maintenance can be a problem. Because of that, FHA generally isn't a fixer-upper loan unless the seller is willing to make repairs before closing. VA loans are one of the most powerful benefits available to eligible veterans, active duty service members, and certain surviving spouses. In markets with a strong military presence, like Abilene, this matters a lot. VA loans often allow true zero-down financing. There's no monthly mortgage insurance, though there is usually a funding fee that can be financed into the loan. Property condition standards are similar to, and sometimes stricter than, FHA. Some sellers hesitate when they see VA offers because they expect repair requests. In practice, that hesitation is often misplaced. VA buyers are frequently among the strongest and most stable borrowers you will encounter. USDA offers 2 very different programs. The one most buyers see is USDA Guaranteed, which is issued through regular lenders and backed by the USDA. It often allows zero down, but it comes with income limits, location requirements, and property condition standards similar to FHA and VA. But if you're open to buying just outside town, USDA guaranteed can be a powerful option. Eligibility can be checked quickly by address. USDA Direct, which is where I worked, is something else entirely. It's aimed at very low and low income buyers in rural areas, and the government, not a banker, is the lender. Terms can stretch past 30 years, and some borrowers qualify for payment assistance that lowers their effective interest rate dramatically. That sounds appealing, but the trade offs are significant. Finding eligible properties can be difficult. Payment assistance is deferred interest, not free money. Closings are slow, and because your lender is the federal government, walking away is never an option. If USDA Direct is your only path to home ownership, it can be worth pursuing, but it requires going in with your eyes wide open. Beyond the big programs, many lenders offer specialty or in-house options. These might include programs for majority census tracts, borrowers using ITINs instead of Social Security numbers, or down payment assistance programs at the state or city level. These can be extremely helpful, but they usually come with income limits, purchase price caps, and location rules. When your budget is tight, meeting every requirement can be challenging. That's why your lender matters so much here. You should always ask what other programs you qualify for and how they compare, not just in monthly payment, but in the total cost over time. We also need to talk about adjustable rate mortgages. ARMs still exist, and in some cases they can make sense, but the housing crisis taught us what happens when buyers rely on future income, future financing, or future market conditions to make today's payment work. My advice is simple: buy the house you can afford today. If your situation improves, you can adjust later. Betting your home on future conditions is risky. If you're buying above standard loan limits, you may be dealing with a jumbo loan. These usually require larger down payments, stronger credit, and more cash reserves. Most first-time homebuyers will not encounter them, but if you do, expect tighter rules. Finally, we need to clear up mortgage insurance. Mortgage insurance does not protect you, it protects the lender. It protects the lender when you put less than 20% down. You pay the premiums, the lender gets the protection. On conventional loans, private mortgage insurance is usually monthly and often temporary. Once your loan balance drops to around 80% of the home's value, it can be removed. FHA works differently. FHA uses an upfront mortgage insurance premium and an ongoing monthly premium. Depending on your down payment and loan term, that monthly cost may last the life of the loan, which can make FHA more expensive over time. VA and USDA do not use the term mortgage insurance as prominently, but they still charge fees that serve a similar purpose. These fees make the loan possible. They do not insure you. When you put all of this together, the real question isn't which mortgage program is best, it's which one fits your budget, your location, your timeline, and your long-term plans. Once you understand the rules each loan type brings with it, the next step finally makes sense. In step 7, we actually start looking at houses, but only houses that fit the loan types you now understand. That's how you avoid wasted time, broken deals, and expensive surprises.